Now, rights issue. So what is the concept of rights issue? We have already discussed. A rights issue is an issue of shares for cash. Company takes cash and issues shares to the existing shareholders. Unlike the bonus issue. In bonus issue, company is not taking cash from shareholders, but instead they are giving shares to the existing shareholders free of cost. So rights issue is an issue of shares for cash to existing shareholders for less than their market value or at some discounted price. Rights are offered to existing shareholders who can sell them if they wish. That means the rights are given to them either to buy the shares at less than market price, or if they wish, if they don't want, they may not even buy the shares. It's upon them, and they can sell these rights to someone else as well. So advantages of rights issue, disadvantages of rights issue. More cost effective way for company to raise finance than a fresh issue to public. Why? Because since in a fresh issue they have to promote the company amongst the people, like in the market. They have to hire promoters for that purpose to like raise funding for the company. And in rights issue, they need not do all that because already there are existing shareholders who are like holding the stocks of the company already, and company only have to kind of issue the shares to their existing shareholders. Disadvantages: lack of shareholder interest may reflect badly on the company. If shareholders are not willing to buy the company's shares under rights issue, then what happens? Then definitely that means that will have a bad reflection on the company, right? A more time efficient way to issue shares, that it saves a lot of time. Unwelcome predators may try to acquire shares where not all rights are taken up. So they are speaking about hostile takeover. Hostile takeover is nothing but company is to a company X company wants to acquire Y company, whereby Y company does not want themselves to be acquired by X company because these two are rivals, or Y company does not want to be under X company. Like Twitter was acquired by by Elon Musk. Okay, Tesla, that is a company name. And in this case, this was a hostile takeover. The Parag Agarwal, who was the CEO, and Elon Musk is the CEO of Tesla. So this company does not want themselves to be under the management of Tesla. Henceforth, they always were very much reluctant to go with Tesla, and they wanted to be an independent company, okay, with their own decision making. But then again, Tesla acquired Twitter in a hostile takeover for $43 billion deal, I think it was. And now the company's name is X now. So what happens? Lot of rights issues. If existing shareholders do not want to take those shares, the predators or the companies who want to go for hostile takeover can buy those shares. So that's a disadvantage. If all rights are taken up, shareholders will maintain their existing percentage shareholding. Of course, if at all 10 rights are available and 10 shareholders are there, all the rights are taken up by the existing shareholders, their shareholding percentage will be the same. Effect on future dividend policy: as company will have issued more shares under rights issue than it would have under a fresh issue to public. So more shares with people, more dividends. So future dividend policy have to be, again, they have to again frame certain fresh policies, like dividend policy, how much dividend they have to give to the existing shareholders, because now the outsiders are not there because of rights issue. One more advantage: as shares offered at below market value, shareholders are more likely to buy them. Will cause the share price to fall as shares are issued at below market value. That's what. Now there is a question of rights issue. We will solve this activity. Please follow. See, the same wrap company's data is given to us. 1 year later, a wrap company is to make a rights issue on a 1-for-5 basis. That means for every 5 shares held in the company, one rights share will be given. For every 5 shares, one rights share. Okay, and the right price is $1.50. All shareholders take up their rights. This is also given. The following statement of financial position extract shows the position before the issue. Wrap company statement of financial position extract. The shares what they had was $187,500. But if I have to find out, the number of shares, I can do that. How I can do that? 187,500 divided by 0.50. Can you tell me how many shares are there? Yes, Sumaya, can you find out and tell me?
Yes, sir. Oh, wait.
Yeah.
Three lakh 75,000.
Yeah. So these many shares are there. Okay. And now we will be seeing the rights issue. For every 5 share, 1 share. For 375,000 shares, how many shares? Cross multiply. Can you tell me now what's the answer?
75,000. 75,000.
Sorry.
75,000.
75,000. So these many shares, and the value of these shares will be how much? As per the nominal value as per 50 cents, 37,000 75,000 into 0.50, that will be 37,500. Okay, so now these many shares, the value of the shares would be this much. Okay, and that is $37,500. Now
Sir, the right price is 1.50, right?
no, this is the nominal value of the shares. Now we are
Yes.
going ahead. Yeah, so the rights price is 1.50. So there is a premium, right? 50 cent is the nominal value. Rights issue has been done at 1.50. Out of that, 0.50 is the nominal value and $1 is the premium. So $75,000 into $1. The premium amount is how much? 75,000. Right or wrong? Hello. Yes. So the total value, the total cash what the company is going to get is 37,500 the nominal value of the shares and 75,000 the premium. That is going to be 1,12,500, out of which the share capital is 37,500 and the premium is 75,000 as explained. Okay, let's move forward. And wrap company statement of financial position. Let's also fill up this one. Already they had 187,500 shares and now 37,500 rights shares. So total is 225,000. In premium account, they had how much value to already? 22,500. And then next, the premium right now it is 75,000. So after adding this, we will be getting 97,500. And retained earnings is going to be the same, that is 230,000. So total amount would be how much? 552,500. Okay, this is the calculation. Please go through this. We will move forward. Done? Shall we move forward?
Yes, sir.
Now, next one. Next comes preference shares. See, this is also a form of like funding what company like arranges, and this is like a debt and equity combined kind of thing. So preference shares is also one of the source of finance. There are two types of preference shares: redeemable and irredeemable. Redeemable is the money has to be given back. Irredeemable, no obligation to pay. In substance, redeemable preference shares behave like debt because they contain an obligation, because like they have to be redeemed back, meeting the conceptual framework definition of a liability. Therefore, they should be treated as a liability. Always you should keep this in mind, and that to non-current until 1 year before redemption. If you redeem in 1 year, it's a current liability. If you redeem it beyond 1 year time, it is non-current liability in the statement of financial position. The dividend should be treated as finance cost, that is interest, in the statement of profit or loss. So it's a non-current liability, and the dividend is like a finance cost should be shown in the SOPL. Irredeemable preference shares contain no obligation, so should be treated as equity. That's what you should understand, the difference between the redeemable and irredeemable preference shares. That is, in the same way as ordinary shares, the dividend should be treated as an appropriation of profit. Okay, appropriation of profit. That means like dividends should be given to them from the should be deducted from the reserves, and this will not be shown in the SOPL. That is what they are saying. Now comes the reserves. Should directly be deducted from the retained earnings. Reserves. The following reserves are commonly found in limited liability company accounts. Okay. The share premium account, typical permitted uses. The share premium account is kind of a reserve which you find in the public companies accounts. Limited liability companies are public companies, and this share premium account can be utilized for issuance of bonus shares or to write off any of the share issue expenses. Okay, that means you can deduct that expense amount from this premium account. Again, you will be seeing revaluation surplus, already covered in chapter 8, that is tangible assets, already explained to you in the previous class. Other reserves as designated by individual company, for example, a general reserve, and retained earnings is nothing but the cumulative undistributed profit. Like every year company may earn some profit, and that may accumulate, and the accumulation of those profits will be shown in this particular account. If there is a loss, losses will be deducted. Dividends, already told you, dividend is nothing but some part of the profit is shared amongst the shareholders. So a sharing out or appropriation of retained earnings to owners, that means you are removing or deducting the dividend amount from retained earnings account and you are giving it to shareholders. There is a question here. Please go through this. We will discuss this question. The illustration 1. So a company with 1000 ordinary $1 shares in issue. So a company with 1000 ordinary $1 shares in issue made a profit of $500 in its first year. So company has how many shares? 1000 shares, and the $1 is each share value, and the profit what the company made is $500. Company has two choices as to what can be done with this profit. So this is a part of dividend policy. What they should do with the profit is what company will decide. Either they can distribute it as dividend to the shareholders or retain it in the business or anything, combination of both. That means out of $500, some part can be given as dividends and some part can be retained in the company. Okay. So if this company decides to pay a dividend of 10 cents per share and retain the remaining profits, how would the financial statements appear? So what they are planning to do, out of this 1,000 ordinary shares, 10 cents per share accordingly they want to pay us dividends. Okay. And whatever is left over after making the dividend payment, they will retain it in the company, it seems, and uh, like in the company, and they'll keep it with themselves. Maybe they may use it in the future for any kind of investment purpose. So how you are going to give the treatment for all this? So profit is $500, we know, for the year. In the statement of financial position, we have share capital of this much, we have retained earnings of this much. How many shares were there? The number of shares are 1,000 into 0.1010 cents. Just calculate how much is that. Hello. It is $100. So this $100 we will be deducting from the profit which we have retained in the retained earnings account, because the current year profit whatever we have earned will be coming to the retained earnings account, and from that we are removing the dividend payment, and now retained earnings account is showing 1400, and this is the in the statement of financial position, the equity amount is 1400. Okay, after deducting the dividend payment from the retained earnings. So please go through this. We will be moving forward. So now what we are going to discuss is dividends on ordinary shares and irredeemable preference shares are charged directly to retained earnings. Yes, the dividends are deducted from the retained earnings account. So that's the reason why retained earnings account is debited, and physically the dividends are paid in form of cash. So which account is credited? Cash account, because decrease.
Excuse me, sir.
Yes.
I'm sorry to disturb. Just I want to say that, like after completing dividend, can we stop? Because I don't feel well. My BP is dropping more, but I can't continue.
What is dropping? Sorry, I'm sorry.
Like my BP is low right now, and like feeling dizzy. So I just want to go for a sleep now.
Okay.
I thought I will be able to cope up, but I don't think so. I can continue now. Like
Fine,
if you
fine.
after completing dividend, we can stop.
Yeah, that is done already. We have finished that.
Okay, sir.
This one was the last one which we discussed. Okay, you mean to say, okay, fine. Shall we do till here then? Then we will stop. Is it right?
Yes, yes, sir.
Okay.
Thank you, sir.
Okay. No worries. So what is happening? See, already you know that retained earnings is a reserve. So it is always a credit account. But since we are deducting the dividend amount from the retained earnings account, this account is decreasing. So that is in the debit, and decrease in asset is always credit. That's the reason why cash account is credited. Let's say how it goes. Retained earnings balance was 500, so 100 deducted. So this went into debit. It's a credit account, but since money is deducted, it went to debit. And cash account had $1,000, and from that 100 is removed as dividend payment. So now we have 900. So decrease in cash from 1,000 to 900 is credit. Okay, so that is what it is. So the entry here would be 100 debit and 100 payment is done. Dividends on redeemable preference shares are treated as finance cost. So you know you will be debiting the expenses always, because increase in expense is debit. So finance cost, and when you are making the interest payment, it is decrease in asset, that is decrease in asset, here the cash is the asset, so decrease in asset is credit, so that is in credit. The company may pay dividends in two stages, either interim, that is in the mid of the year, and final at the end of the year. If enough profits are there mid of the year, if they don't have enough profits in the mid of the year, so in the at the end of the year also they can make the dividend payments. Fine. Okay, then we'll stop here. We will continue this activity tomorrow. Okay. Okay, Maya, then take care of your health. Tomorrow dot 8
Yes.
p.m. will be connecting. Yeah. Thank you. I'll finish this
Thank you.
one. Thank you. Thank you.